Hello everyone. Fair Isaac is down by 35% from its recent all-time high in December. They're a really good company and they have a very strong revenue base, and it's been performing extremely well over the last 5 years, as you can see compared to S&P 500. However, after recent issues and changes with the VantageScore, which we'll be looking into, they have actually dropped significantly recently, and this is a major issue as it might damage the moat, and we'll be looking into if this company is an opportunity now or not, or if they're still too expensive after what happened. So to begin with, FICO's revenue comes from two different sources, where about 53% comes from scores and 46% comes from software. Their software side of their business is where they lend tools for banks and companies, things like credit decision software and fraud detection, as this is kind of a subscription-based tool software, which is really important as it's predictable, and this is really good for long term as there's also high gross margins of about 70 to 80%, and the cost is more for R&D and support. However, the other side of scores, which is a much more recognizable revenue source, as everyone knows about the FICO score, is when FICO earns money here anytime a bank, lender, or mortgage company checks somebody's credit score. So it's somewhat like a fee. And they've had a monopoly over this for several years now, and it's been a massive growth driver for them. With 80 to 90% gross margins, which are extremely impressive and are very efficient, FICO has nearly tripled their revenue for their scores over the last 7 years. And this is really important as this has been one of the most strongest businesses that they've had and have been a major reason for why FICO has performed so well over the last several years. However, the recent crash has been because of this change, which targets scores. As FICO tumbled on Tuesday after Federal Housing Finance Agency, also known as FHFA, announced that it basically is using the VantageScores, which are from Equifax, TransUnion, and other companies which sell mortgages to companies like Fannie Mae and Freddie Mac, which are basically mortgage lenders. And so far, FICO has had a monopoly over this, which basically has just bolstered the company to higher and higher prices as people believe that FICO had pricing power on it. However, this change is hurting their business, and this is a major business for them. So we're going to look into if this is a good opportunity now or not. FICO's price to earnings, forward price to earnings, and price to sales are all very expensive right now, as they're trading much higher than the S&P's multiples of 22 PE to 20 PE, and their price to earnings growth rate, which is basically showing the price to earnings to future growth, is also somewhat high at 1.72, where it's usually recommended for it to be a 1. However, I don't believe this is the best metric to look at the valuation of a company, as this could be really mistaken as it's only using price to earnings. It's also important to look at the free cash flow of FICO, which has been very consistent over the last several years, and this is a good show of how FICO has done over the past couple of years. However, it's not the best metric to look at when looking at future. As FICO's earnings have also done similarly well, they are expected to even grow further in the future. However, this forecasted growth by analysts may not be including their recent changes, which are most likely to hurt their monopoly and could reduce the revenue that their scores are getting. However, because of their software business, I do still believe this company will grow and will grow pretty continuously, as they still have somewhat of a pricing power. However, they are just having reduced impact in that area. If you do hold this company right now, I would not recommend selling it, as it is a really good business. However, I would not recommend buying this right now at the price they are at right now of 66 PE and a forward PE of 47. It is somewhat expensive right now. However, if this price does come down to around in their 50s or even 40s, I would recommend that this is not a bad time to buy, especially if their growth continues and if their monopoly isn't hurt too bad. Also, their software side is still an amazing business, a subscription-based business with still high margins. And their overall business also has incredible margins of about 30% and have been growing that continuously since 2020. And it's a really good business overall. I do believe this is one of the best businesses to buy to buy at a good price. However, as you know, the price is the only issue here, and I would recommend buying this at a different price and making sure you're updated with any news that might hurt their monopoly more or possibly even improve the strength of their moat.